My name is Adebisi Opoluwa Eniola, and then I'm here to present corporate finance and risk presentation. And My company of choice is SSC. And then I said SSC is a multinational public limited company limited on LLC, representing one of the biggest energy firms in the UK, formerly known as Scottish and Southern Energy PLC. But following the no premium merger of both companies, it's become SSE PLC. So according to SSE PLC all across the UK, SSE is involved in transmission, production, distribution, generation and supply of electricity, storing, production, distribution and supply of gas, and further energy services. And then we talk about the firm currently has the market capitalization, price earning ratio, turnover, net income, annual dividend of 40%, net income of 3.0%, the turnover of 6.61%, price to earning ratio of 7.51%, and the market capitalization of 7.76 billion. Then we'll talk about the financial statement analysis. This is the graph. In terms of profitability ratio, the gross profit margin has to be improved, as a 50% to 70% ratio is considered good. And the net profit margin has been good for the past 2 years, with a percentage above 20. However, a low net margin under 5% is low, which is the case for 2018-2020. And then we'll talk about the financial statement analysis. This is the graph that according to net asset turnover, SSE ratio decreased significantly after 2018, which means that they are not managing their assets effectively. In terms of return on equity, a good ratio is above 20%. SSE has exceeded that for most of the years, with 2020 being the exception at 0.33%. And then talking about financial statement analysis. According to debt ratio, the company had a high steady debit ratio from 2018 to 2020 level, and it started decreasing the debt ratio for the next 2 years, which is beneficial for the company. So the capital gearing ratio for SSE is considered high, and which is high on 2020. And then the financial statement analysis. The interest cover of the company is high, which indicates the SSE can make the interest payment on time. In 2020, the interest cover ratio is at its lowest, however, it's still considered good as they are still able to make the payment. The financial statement analysis, the liquidity ratio. SSE liquidity ratio has improved significantly for the years 2021 and 2022, which means that the company has more current assets than liability to cover the amount of debt, this is the liquidity ratio. The financial statement analysis efficiency ratio. According to the creditors payment period, the company has a bad credit payment period when compared to the debtors period within the exception of 2022, as it is clear that SSE is paying out their creditors before receiving money from the debtors, and that is bad for the company financial health. And then the earning per share of the company has a good ratio for most years apart from 2020. This is the most probably due to the COVID-19 pandemic. So we know the impact of COVID-19 pandemic on companies all over the world. And then since SSE is a multinational company, COVID-19 has some slight impact on the company productivity, profitability, and revenue. And then the financial statement analysis, cash from operating activities has been in line with the past and no a huge improvement since 2019. However, after 2021, it's seeming that the company has been in decline. In terms of cash flow from investing activities, cash from investing activities have been in line with the past and no a huge improvement from 2019 to 2020. So share price trend. Here, based on their graph and data with the inflation, SSE PLC seems to see its share price increase steadily and have been on an upward trajectory, and that is since the stock market correction and occurred in March. As you notice that the share are currently trading for around £1,802. When the market correction occurred, the share reached as low as £1.65, which is a very low reduction, which is almost a 16% increase in less than 6 months. We have the capital structure and trade. SSE PLC registered a return on capital employed of 38.13%, which they outpaced their own industry, which this later delivered a less exciting of 12.2% this year. This looks great since we recognize that SSE has made big profit from their slight equity capital However, a higher ROA might be preferred. And we have capital structure analysis and trend by looking at average leverage, but its capital return on capital employed can be inflated by excessive debt. So a further analysis of excessive debt to equity is required, for which currently their debt to equity ratio stands at the balance 12.6%, meaning their ROE ratio is driven by its ability to grow their profits without significant debt burden. Share price estimation of year 2022. The forecasted share price of SSC can be calculated as the portion of current price per share. The portion of current price per share, or by using the popular approach used to assess a stock intrinsic value, which is the PPE ratio, is easy to use and the data is readily accessible, as we need to use the SSC available historical price to any ratio and multiply it by the estimated EPS. The estimated EPS, the share price estimation of year 2023, SSC PLC stock forecast for 2023, and according to SSC PLC stock price prediction by technical analysis, many analysis based on their calculation, analysis, and evaluation produced 12 predictions over for each month of 2023, and are with average SSC PLC forecast of 2197.03, a high forecast of 2335.35, and a low forecast of 9973.06. And this is the graph showing it. And then the conclusion, that from all these we can conclude that SSE as a business is doing well, from which according to the highlighted profitability ratio, solvency ratio, liquidity ratio, and investment ratio for the last 5 years, we can say that their financial health is doing well, without forgetting that they know a continued increase in terms of all profit margin, interest cover, liquidity ratio. Additionally, during the last 2 years, the company has seen decline in GRP ratio, financial leverage, increased earning per share, liquidity ratio, and turnover, better solvency ratio. Notice that even the inflation cost of energy prices. And then we'll talk about recommendation that nationalization aim to nationalize the wires that transfer pipes and electricity that nourish the state's gas supply, as currently we witness a huge inflation in terms of cost of living and energy prices in the UK, from the many Britain suffering from that. In addition, there are 10 complaints in the United Kingdom, including the KDET, UK Power Network, and National Grid, and the 6 business energy. So, nationalizing this significantly means realizing them. So, by creating a national energy agency to sustain the infrastructure and grid performing as an independent civil body, this would be a significant reform. So, by nationalizing those complaints, not only that will cut bills and still pay sky-high prices of foreign coal, oil, and gas, but also it will impact them in terms of their operational costs and investment. And regarding both large FTSE 100 company, including SSC in our case, which this company will lose substantial extent of its current assets and will be exposed to takeover. So that is my take on the presentation. Thank you very much.